Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
Well, welcome everyone to our first in a series on the top 5 retirement topics ignored by the mainstream media. In this segment, we're talking about survivor strategies for remaining spouses with economist, best-selling author, registered investment advisor, and masters of science and financial services, Dan Casey. Dan, I don't have too many guys that have an MSFS that walk in this door, so welcome.
Nice.
Welcome to academia, all right? I talk about not only are you highly credentialed, and you are, you have some serious media. You've been in Forbes magazine, Wall Street Journal.
Yes.
You've been in Wall Street Journal. You've been quoted there. And I also noticed that you have a couple of books out, right? Is it 2, I think?
Yes, 2.
To give me the first one, because that's the title that's kind of everybody goes, what is that title?
You know, it came after working with a lot of widows. And what it was is mostly the husband handled the finances. So when he passed away, she was stuck with all that. So after working with a lot of widows, they always would say, people would come over and bring them casseroles, but nobody would help them deal with everything that they had to deal with. So I named the book, Forget the Casserole, Help Me Deal, Heal, and Live. So it really helps them walk through everything that they're going to be hit with.
And they can get that at Amazon.com.
Yes. Yep.
But by the way, that's a great book. So if you're, especially, that is a great book for the ladies of our people who are watching it.
Yep.
And what's the second book?
The Coming Inflation Crisis and the 4-Step Action Plan for Retirees.
Wow, you are Mr. Contrarian, I have to say. You are.
I'm a firm believer that, my undergraduate degree is in economics. So I'm a firm believer that there's going to be a price to pay for the $4.2 trillion that we printed getting out of the Great Recession. So there's just the usual end result for that is going to be inflation. And I know we're not, there yet, but I think there will be a price to pay.
Well, I've been hearing about it, and interest rates going up. I haven't seen it yet, but you're the doctor. I'm going to go with it. Let's talk a little bit about something else here. You have a very, very interesting. Your book was forwarded by Barbara Cochran from the Shark Tank.
Yes. So I managed to get her the manuscript, and she read it, and she said she loved it. So she just wrote some really nice comments on it, and said it was time for something like that.
I got to tell you, Barbara's my favorite gal or guy on Shark Tank.
Right.
This gal's got crack discernment. She could read a person, and I tell you what, if you are not in the zone of honesty, you are going to get your head handed to you.
You better have thick skin, yeah.
That's right.
She tells it like
she does, and she's really quite. Her story alone is
amazing.
Is an amazing
Nothing
story.
short of amazing. Yep.
Well, let's talk about the story with your clients because you're kind of doing some amazing things. Let's talk about when we first talked about this on the phone. Spousal strategies, dad dies 87% of the time. First, before mother.
Yep.
So everybody goes, I'm sorry it happened. Just about the time where the grief, you're just trying to get over it, you find out, oh, my Social Security just got cut.
Yes.
My lost exemption for my husband.
And that's the big
now
one.
the tax bracket just went up.
Yep.
Could affect my Medicare Part B payment.
Yep.
Of all the things that they should fix in legislation, this, in my view, should be fixed.
It's amazing. Because people think that, when one spouse dies, the income's going to go down dramatically. But if you look at it, they're getting Social Security. So, yes, they'll lose, the one check, but they get bumped up to the next. Pensions usually don't change. If you're pulling investment income of some sort, that usually doesn't change. Required minimum distributions, IRS still wants their money. Those continue. And usually, sometimes it can even go up with life insurance if they had a premium that's going to increase their assets. Income does not go down, but you lose that one exemption, and that's huge. So let me give you an example. If you're making $75,000, you're solidly in that 15% tax bracket when you're filing joint. If you now file single and you still have around $75,000, bumps up to 25%. So that's a huge increase. And that's just your income taxes. So if you brought up the Medicare Part B premium. Now, if say you're making like $90,000 and you file joint, your premium's $121.80, I believe. And that's filing joint. So when you go single, now that your income can even go down to $85,000, that Medicare Part B premium still jumps up to $171. So that's almost a 30% increase. So very frustrating that that loss of exemption can hit the spouse so hard, the surviving spouse.
Well, see, now this is, when I usually talk to people like yourself, I usually understand, I understand we got to manage taxes in retirement. I kind of get that. And I think most good, comprehensive planners are going to address that.
Yes.
But I don't think anybody, I think what do you call this? You call this the stealth tax, right?
Part B stealth tax.
This first death scenario can really wreak havoc, and generally it's with mom.
Yes,
exactly. So it's
exactly.
really, we're adding insult to injury and over a grieving of losing your partner. So talk to me a little bit about, is there any way to prep for that? Can I defend against that?
And usually it's because the IRS doesn't care if you're getting tax-free income. It's you can be making $60,000 a year, but if 30 of it's tax-free money, they don't care, and that could lower Social Security taxation. So the key really is to try to get as much into that tax-free scenario as you can, so income doesn't jump like that, and it can decrease, so you don't jump into different taxation brackets. And from watching your show for so long how all that's done. It's obviously Roth or money coming out of your home using a reverse mortgage, that's a loan, not income. Cash balance, you're borrowing, so that's not income. So a lot of tax-free ways to increase your income without get the IRS involved.
Let's just touch on that just for a second, just because you brought it up. There's tax-free, which when I think of tax-free, I'm old school municipal bonds.
Right.
That's truly tax-free.
Yes.
Reverse mortgage, non-reportable loan on an equity position of your home.
Yes.
Life insurance, non-reportable collateralized policy loan against your cash values.
Right. Yeah.
There's two different, and Steve distinguishes it. Not that the IRS cares, because either one is free. But let's talk about the real bad boy issue, because my consumers always get this mixed up. Steve, I got my tax. I started getting my money from my distributions, and I'm so used to when I was working, the employer took out my taxes, and so my net money was my check I got in the mail was my check to spend.
Yes.
That is not the way it's working in retirement. What happened?
No. Yeah. It's up to you now. No employer. It's and that IRA money is fully taxable, and I see it all the time. Like, if you're,
can I ask you something?
Yeah.
This is another myth of my client, Steve. Don't we get like a return of basis on this?
No.
I mean, because people say, isn't part of this my original contribution?
Right. No. See, and I can take advantage of the IRS. A lot of my clients, it's okay if I take advantage of the IRS. They don't mind. So what you do is, if you scour the tax code, just the way they taxed, like, for instance, annuities, deferred annuities, the first thing that comes out is all your profit, your gains, so it's fully taxable. Well, if you can convert some of that to maybe a SPIA, a single premium immediate annuity, now it's taxed differently. Now it's, when you get money back, it's part return of your own money, tax-free, part gain. So it's kind of like coffee. You put in the cream, stir it up, pour it out. Mostly it's going to be coffee, a little bit of cream. You can't separate it. So it's knowing how the IRS tax different annuities is ways to maybe shift your income so it's not, fully taxable.
Okay, so if I have a client and he goes, Steve, you just gave me the wake-up call. Dan told me I have to pay taxes on my qualified plan, and on top of it, I have no basis. Okay?
Right.
I didn't like that.
Right.
But then I find out, this is the other part, and it really irks seniors. All that distribution from qualified plan flows over to the provisional income test of Social Security, and now my Social Security can be affected by my qualified plan distributions.
Yes, and I was going to hit when you said municipal bonds. Now, and a lot of people don't know, that's tax-free money. That's great if it's in the right municipal bonds. Well, when you're figuring out the taxation for Social Security, as you know, that income is added back in to figure out your provisional income. So people think it's tax-free money, but it's being used against you to figure out your taxation on Social Security.
Well, let me just tell you, I'm bothered by all this, because I'm
sorry.
a senior. I'm saying rescue the seniors. You are the voters. You need to wake up to this. Listen, I want to. If I'm taking municipal bond income, it's bad enough. It might even trigger the alternative minimum tax.
Right.
But the bigger issue is you guys got to get off reading the last line of your 1040. Adjusted gross income at the bottom isn't where the game's played anymore.
No.
You got to go to page 2, modified adjusted gross. So not only could my municipal bonds, maybe because of a preference item, trigger a alternative minimum tax, which would be a really bummer if you really bought those for tax-free.
Yeah, right.
And then all of that, doesn't matter how it is, all that municipal bond income is treated for taxable event for Social Security. The guy says, Steve, you're telling me my Social Security, which is an ordinary income tax, is being caused by a tax-free distribution.
Right.
How can that be? Remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information right from this segment. In our second segment, we're going to address the new house wealth strategies with Dan Casey. I'll be right back right after the break. The number one fear of American seniors is outliving their money in retirement. Hello, everyone. I'm Steve Savant, syndicated financial columnist and talk show host. The Guinness Book of World Records for living the longest is held by Gene Kalman, who lived 122 years, 164 days. And that's a fact. But it seems like science fiction to consider living to age 150. But according to a leading gerontologist, that person has already been born. Every day in America, seniors are turning age 100. It's the fastest growing segment among retirees today. And tomorrow, you may very well be one of them. Could your retirement plan go beyond age 90, age 95, or even age 100? Now you can purchase guaranteed lifetime income no matter how long you live. And that income can also include annual increases to help maintain the purchasing power of your retirement dollar. So just go to www.rightonthemoneyshow.com and click on the free income calculator to determine how much guaranteed lifetime income you can purchase. Well, welcome everyone to our first series on the top 5 retirement topics ignored by the mainstream media. In this segment, we're talking about the new housing wealth strategies with economist, best-selling author, registered investment advisor, and Masters of Science in Financial Services, Dan Casey. Dan, again, I salute your academicness. You're author of 2 great books. I love the casserole book. I'm a food guy, so I don't know if I want to do away totally with it. We're saluting your forward in the book by Shark Tank, Barbara Corker. Barbara, we love you. Let's talk about the HECM strategies. Now, HECM is a acronym for House Equity Conversion Mortgage.
Yeah, and it's that M word that I think why it gets a bad name. You know, my clients, I only deal with those retiring or about to retire. They spent their whole life trying to get rid of their mortgage, right? They don't want a mortgage in retirement, so they hear the mortgage word. And they immediately, they're immediately out. The problem is, though, it can be an awesome strategy for retirees. And the difference between this mortgage and the conventional mortgage is there's never payments. So it's a great opportunity to take out income from your house and pay off the mortgage, not have any payments, create more income, use it for long-term care. I mean, it's really the reason why the government created it. It's almost 30 years old now, and they created it to really increase your income by taking longevity risk off the table, which is a risk multiplier. So, well,
let's just talk about it. In 2008, we had the housing meltdown here in Arizona, where we're recording. It was bad news. My house got whacked. Everybody felt it. We also simultaneously took huge hits in our 401ks, which basically only got back to par in mid-2015.
Right.
So we know what it's like, and a lot of people are still struggling. They had a vision of the house of their dreams, and they're not getting it. So HECM does a couple things. I have people that come and say, Steve, I want my Social Security right now at 62. Well, okay, but you're giving up all that money. If you can just wait 8 years, it can max it. So how do I get there? I might be able to use reverse mortgage income for that 8 years just to stall till I can max my benefits.
Yeah, I always try to come up with strategies to try to stall Social Security because, like we talked in the earlier segment, money coming out of Social Security can sometimes be taxed 50 cents on the dollar. IRA money, whatever, it's not. So we try to get that as high as possible, and this is one of the ways that can happen is pulling money out of your home to bridge that point until you get to that. Because let's face it, the higher wage earner Social Security check is not only that person's check. It's the surviving spouse's check for the rest of their life. So I try to get it as high as possible. But you're right. When people sometimes, when they get to 62 and they've got money coming to them, they say, give it to me. But the HECM can be a great way to bridge that gap.
Well, you just said another thing, too. Listen, Social Security and the things we're talking about are not a me decision. They're a we decision.
Yes.
So, we have to think about both people here.
Correct.
So, to me, stalling, if you can, to age 70 and using reverse mortgage, all that money's coming out tax-free. You don't have to worry about that. And then you're going to have a choice at 70. Should I pay the 8 years back that I paid on this?
Yeah,
should I just stop it and not have to? Remember, you don't have to.
Yep.
Or hey, I like the income. I'm going to keep it coming.
Yeah,
So you'll have a choice. But this second one I want to talk to you about. When I first heard this, I thought the person that was speaking was completely ludicrous.
Did you check
I checked that thing so bad you have no idea. I sent all the minions from ASU down, all the little interns, and you could buy a home, maybe the home of your dreams, as long as the value didn't go over $625,500, you could buy a home for $625,500 or below.
Yep.
And if you're 62, you pay about half down. If you're older, it's even less. No mortgage. What's with that, Dan?
It's part of the reverse mortgage system that a lot of people just don't understand. It's not talked about. Again, in mainstream media. No. In a couple, one just has to be 62. The other one can be, whatever, younger, a lot younger. And they can take advantage of this program. And the way they come up with how much you can get is using three factors: the value of the house, interest rates, your age, and obviously as you get older, that timeline's, you can get more because the timeline's shorter. And then whatever that value is what you can use as the payment for the house, and it's amazing.
In one of our seminars, we had a person say, "Steve, I brought this up," and the lady said, "Steve, I have $250,000 left over to the sale of our home. My husband and I were looking at a home, a little townhouse or something. That's all we had. We got hurt really bad in 2008 in the housing crisis here in Arizona.
Don't want another mortgage payment.
And I don't want another mortgage payment." She goes, "After you saying this, how much house could I get?" And I said, "Based on your age," he was 73, she was 72.
Yeah.
"You can get a home of about $540 grand
Yeah, it's
for
amazing.
$250.
It's amazing.
And I got to tell you, she got a little wet-eyed because this is why this law. This is not. It's a great law before we had problems in 2008,
Right.
but it really is a punctuation point to retirement planning. Now let's talk about this third one. This is absurd, in my view. I mean, the government is coming up with an equity line of credit, but it's not just any equity line of credit.
No.
Dan, talk about that.
Yeah, it's the typical line of credit. They could cancel at any time. They could change the. It's completely different than this. It's basically if you don't take the lump sum, you can take a line of credit based on your house, and whatever the unused amount is, you get a basic rate of return. I think it's like 5.5%.
It's actually 6.2 now.
Is it 6.2?
It just went up. Yeah.
Amazing. So that whatever the unused portion is, that gets added and it actually grows. And it's just amazing.
Okay, so let's make sure we do the mechanics. Under the old traditional line of credit, you'd have to pay the annual interest.
Yes.
You'd have to satisfy the note at the end of 10 years. They
Yes.
could actually call the note,
Absolutely.
especially if the correlation of your house value went down.
Right.
They could say, "Hey, you need to pay it up." And no FHA insurance. Okay, that's the traditional. In the HECM or reverse mortgage scenario, you don't have to pay any annual interest.
No,
you never have to pay the note back.
Right. And now that you hit on that, if the house value goes down, a lot of people say, well, what happens if the housing market crashes? I guess that can happen from the past. If the housing price goes down, what happens? And of course, most people know that there's a non-recourse on this. They can't go after you if there's a difference in the.
To me, this is huge. And by the way, I have so many clients that I meet too late in life, I'm sorry to say.
Yeah.
And they say, "Steve, I have no long-term care or anything else." I said, "I got something for you. I want you to take out one of these HECM appreciating lines of credit. You may never use it. Who knows?
Right.
But if you do use it and you do need assisted home living, this could be a play."
Yeah.
So and by the way, even if you had a long-term care contract, I still want a money reserve.
Right, exactly.
This is for like the absolute backstop.
Yeah, and and let me separate there. When you qualify for Medicaid, your house is one of the protected assets. So you can do a reverse mortgage up to whatever the limits are, and it doesn't matter. It's not considered income for that purpose, and your home is protected
for Medicaid.
For Medicaid.
Wow.
For Medicaid.
So there's no spend down.
No spend down.
Yeah, I think that's huge.
All other things.
If you're listening to this, you're saying, "Steve, this is too good to be true," just write me, steve@rightonthemoneyshow.com, and I'll send it to you. I want to talk about this combo thing now.
Yes.
Well, we talked about getting money, reverse mortgage, buying a home with the HECM law, having an appreciating line of credit. What's the next one?
It's that. It's being able to do that, getting the line of credit, and it's again. So you're buying a home that's worth a lot more than what you could get. No mortgage payment, and then a line of credit on top of it to for any of those needs, like you said. It's just,
the house I just saw, the guy did. He says $500,000. Now, if he would have not bought the line of credit, he only need $225,000
Right.
down.
Yeah.
He's done. No mortgage. Well, think about that. You bought a $500,000 home for $225,000 and no mortgage. Right. However, he said, "I want to be able to have an equity line of credit," so he put down $325,000 instead. So now he's got $100,000,
Yep.
and he said, "Steve, as an investor, as an investment advisor, can you beat 6.2? Guaranteed, no.
No, it's
I can't
kinda
touch
hard.
it. Can't touch it.
Right.
So he buys the appreciating line of credit. He may never use it, but he can if he wants for whatever. And a lot of people now are using that equity line of credit to make their home more geriatric safe.
Right.
Right?
Yeah.
And all kinds of things going
That's
on.
another
right
case.
now.
When you qualify for Medicaid, they don't care how much money you put into your home. If it's into your home, that's a protected asset. It's good.
I tell you what, that's a huge thing to keep bringing up because to me that's a powerful way to use home wealth.
Yeah,
Just
absolutely.
a powerful way.
Yeah, for
now
sure.
in your practice, now we're looking at all this. There's nothing off the table.
Right.
So I remember this is like going from checkers to chess. You know, there's only so many moves on the checkerboard. The pieces only do so much.
Right.
You go on a chessboard. This is integrated financial planning at the highest levels.
Yes. You've got to look at everything when you're dealing on that. On the distribution side of the mountain, we'll probably get into that, but yeah, it's a whole different ballgame on that side.
So I'm totally on these HECM laws. Now, when you introduce this to clients, how do they react to this stuff?
Well, they always come up with the misunderstandings of the government owns my home now or whatever, and nothing changes. You still pay your taxes, you still do everything. It's still your house, and nothing changes as far as
It's
that
your
goes.
house. You still own it. No hassles. Remember, if you're listening to our show on radio, iTunes, or podcast, you can view the video version right online at rightonthemoneyshow.com and request information right from our segment. In our third segment, we're going to talk about missed opportunities that you can make a difference in your lifestyle with Dan Casey. We'll be right back right after the break.
The Guinness Book of World Records for living the longest is held by Jean Calmette, who lived 122 years, 164 days. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. Will you live to be a super centenarian like Jean? Of course, no one knows how long they'll live or if their family history will be any indication of their lifespan, especially in light of constant medical advancements. But the odds are ever increasing that a significant segment of seniors may live to age 100. But without some idea of your life expectancy, it's difficult to make plans for the future, especially for retirement. While there's no exact science in computing how long you live, you can get an idea by taking a life expectancy test. Then you can use the results to create a timeline for your retirement plan. And don't forget, when you take the life expectancy test, always answer the questions as honestly as you can. So just go to www.rightonthemoneyshow.com and click on the life expectancy calculator so you can get an idea if you're ready for retirement.
Well, welcome everyone back to our series on the top 5 retirement topics ignored by the mainstream media, the evil empire. And in this segment, we're talking about the missed opportunities that can make a difference in your lifestyle with economist, best-selling author, and registered investment advisor and masters of science in financial services. I feel like you're a ninja, Dan Casey. Dan, let's talk about it. Let's talk about the first one, which nobody knows. And I think America has changed. You know, the Obamacare came online. A lot of people used to have FSA accounts. They still have them, but people went to the HSA accounts because they have high deductible Obamacare type medical insurance. Now, a regular person can put $6,550, him and his family, the max, tax deductible, and if it's used for medical, tax free.
Yeah, and if they're over 55, add another $1,000.
Add another $1,000.
Right.
So I'm all over that, and I'm into gaming that thing to the wall. So I love that. That's a great opportunity. Talk to me, though. This is odd. Talk to me about the one-time exemption to move taxable IRA money into an HSA. That sounds whack.
Another part of the tax code that's just not talked about a lot. It's QHFD is what the acronyms. I love acronyms, right? Our industry's full of them. Qualified HSA funding distribution. So you're allowed to take that money from an IRA and put it into an HSA. And it's completely tax-free.
So the transfer from the IRA
transfer
to
is
the HSA
completely
is free.
tax-free. Yep. And if you're younger than 59 and a half, obviously you'd be paying a penalty if you took that money out. Not for this particular transfer. They waive that.
You can do this anytime.
Yeah, anytime.
So I could be 25, and if I want to move it, my one-time exemption, I can do it. Now I can't. I think I've heard the wrong. I can't make the one-time transfer and make my annual contribution at the same time.
No, yeah, that's your limit for the years. That's $7,750.
I would say I love this. I mean, that to me is you're going to pay full taxes on an IRA. There's no basis. It's all going to fall under. It's going to hit your Social Security as well.
Yep.
Why not just take this out of the picture?
Yeah, exactly.
So that's one of your first things you look at as a first strike or first preemptive
Take it out of the
strike.
IRA, right, and make it a tax-free event.
Hey, we were talking in the first segment, we were talking about spousal tactical issues to help during the torpedo tax, or I call it, you call it self-tax.
Yeah.
What did you talk? You were talking about survivor benefits for especially for mom. Dad's died. He's under. She got IRA options here.
She does.
What was that about?
And they have the most. if it's left to children or whatever, they have very limited options. They have to roll it into a beneficiary IRA. In fact, if they don't, it's fully taxable, null and void. The IRS doesn't appreciate that. So, but the spouse has the most options. They have 3. They can roll it into their own IRA. They can roll it into a beneficiary IRA, or they can just completely disclaim it, and they may do that for estate tax purposes. If they disclaim it, it goes to the contingents, so it's out of her estate. If it's a huge IRA and they want to get under that estate tax exemption. But there are reasons why, for instance, let's say the husband was taking required minimum distributions and the wife is not there yet. If she doesn't want that money coming out, she can roll it into her own IRA, then required minimum distributions stop. They'll resume at her age when she's supposed to take it.
Wow, so this is really huge. I mean, I'm thinking of people who, the odds are dad's going to die first.
Yep.
Mom has now serious options on dad's IRA as well as her own.
Yeah, exactly.
How many times do you have to play this game? This is like we're into the deeper level here,
There's things that people don't think of. Like, if the spouse is younger than 59 and a half and she wants that money, then don't roll it into your own IRA. There'll be penalties. Roll it into a beneficiary IRA. She can still do that. And then now it's not her own IRA and she can take the money out penalty free. So it's just knowing all those little nuances in the tax code.
I know. You are the ninja of this whole gig. I mean, you really have.
I might steal that, by the way.
What's it?
The ninja.
Well, you are. I mean, you're highly credentialed. You know what you're talking about. You're an author. Barbara Cochran loves you, Let's go to this next one, though. This is a shocker, and I have to tell you, even the savant, I don't think I picked up on this. Your Roth contributions for kids. And I was like,
I love this one, yeah.
For kids?
Right, because nobody knows about that.
I didn't know it. I'm just confessing. The font of all financial knowledge did not know this. So.
And here's the great thing. The IRS could care less who writes the check that goes in the various tax-deferred accounts, IRAs, Roths, whatever. So what I tell some of my clients, if they have grandkids, and say they're mowing lawns, paper route, and they made $2,000 that year or whatever, they can write a check and put it into their grandkids' Roth.
Grandma and Grandpa
writes a check, puts it into their son's Roth. It's just whatever earned income they have, they can match it up to the limit. So they put it in, and then if the kids use it for education, then it can come out. Obviously, Roth contributions can always come out penalty free. They've already been taxed, so but if you hit earnings, that can come out penalty tax free if it's used for education.
Before 59.
Yes.
All right, let's just make sure I got this right. So the child still has to have some kind of earned income.
It's got to be earned income.
Okay, but Grandma and Grandpa can donate to it to match that up.
Yep.
Okay, they've done that.
Yep.
They can either use that and just let it ride forever, but if they was going to use it for education, I have my Roth IRA, I'm 16, I'm mowing lawns or whatever, how am I moving that? How can I do that before 59 and a half?
How can you do what?
If I'm putting this money for my education.
Yeah, you just withdraw it, and then
from the Roth.
Right.
And as long as it goes to education.
Yeah, when you withdraw it, you just fill out on the forms what it's
no
used for.
59 and a half issues.
No 59 and a half, yeah.
I'm sorry, I did not know that. That's
it's a
a
good one. I like
huge
that
piece of the pie. Here's one I did know, and I'm in shock. I have to say, paralyzed by it, actually. About 4 or 5 months, they did another update. Every so often, USA Today or Fox News or somebody does an update, and every time they bring this up, everybody hits the online blog. People are leaving. We have now over $1 trillion in qualified retirement monies that you have left, America, back at your prior employment.
Yeah.
$1 trillion of unclaimed retirement money.
Isn't that amazing?
No, I mean, I stand by it. Now, let's talk about that. Steve says, Steve, you have so many things you want me to do when I hear you on the show. You want me to do a risk tolerance test. You want me to do a budget. You want me to do a life expectancy test. Yes, I do. All of them. Now I'm adding another one to your plate. I want you to write a complete work history, an employment history. I have found, since I started reading these articles, I have found money sitting back there that you forgot about.
Wow.
I mean, now we're talking about real money. And the biggest one I've heard, it wasn't my client, heard about was almost $300,000. Now, how can you leave $300,000?
I don't know.
But they do. So abandoned IRA, abandoned 401k, right? They're out there. And I think you start, if you're listening, say, Steve, I never thought about that. You need to do a work history on yourself and go back. Did I get that one?
Some people have they have accounts everywhere. I see this all the time when they come in. They'll have like Roths here and there, IRAs there. I think people just get over-inundated with all these statements and they forget that they have money.
Oh, to that point. Is it really worth it then to consolidate all my Roth accounts? Would it be worth it to get my qualified monies down to one, but maybe the cost of just the cost of having it in a 401k versus an IRA, that could be a reason to do it.
Yeah. And I find that people just prefer to have it consolidated. They think that they're being diversified by having IRAs in so many different places, but setting up my firm the way I have, I can invest in anything in the universe in one IRA. So it's not that you can't be diversified. But what I found is when people do have multiple IRAs and multiple Roths all over the place, they don't have the beneficiaries set up right. If they did a trust, they didn't properly go through every one and put the trust in the proper beneficiary placement.
So are you saying, though, that he may have multiple Roths or multiple IRAs or so forth and different beneficiaries and so forth, unintended?
Yeah, or absolutely. And these institutions merge and they get bigger and they don't have these beneficiary forms half the time. So it's up to you to make sure that you have these beneficiary forms.
Well, really, Dan, this is why I love you to have you on here. This is the second time I've had you on. You're one of the few highly credentialed academic scholars that actually are comprehensive retirement planning. I just don't see that many people that are doing the full boat and know the things that you know. I mean, really, you're a walking encyclopedia. I want to talk about, when I'm thinking about all these things, should I consolidate? I need to do record keeping. This is driving me crazy, right?
Right.
How much of this do you take on for the client so they can end this?
That's why we have the staff that we do in the back end. They handle all that stuff because it's a paperwork nightmare to transfer it all over. But transferring money, they're non-tax events. It's just you're saving probably yearly fees at the various brokerage firms, so it might save you a little bit of money. But it's a tax-free event. We transfer everything custodian to custodian, so we don't have to deal with the new rollover IRA rules. So. We try to do as much as we can for our clients.
I'm telling you, I just saw this report that talks about the actual total cost of all custodial costs being in 401ks. They were talking about the total cost, a couple hundred grand. It was a couple hundred grand. Why do we need to consolidate? Why do you need to get a hold of it? 200 grand on some of these accounts. Remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information right from this segment. In our fourth segment, we're going to talk about elder care retirement with Dan Casey. We'll be right back right after the break.
Over 50% of those who have life insurance may be in the wrong rate class and more than likely are paying too much for their coverage. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. Sometimes you just need a second opinion to determine if you're actually getting the best deal. The insurance industry has just updated the mortality tables to reflect longer life expectancy, so premiums are expected to go down. And additionally, there are life insurance companies that are more benevolent if you have a medical problem than other companies. And when you consider that most life insurance companies offer lifestyle credits for those who practice good living habits, well, you could save a lot. But an additional value here is the vast majority of life insurance companies offer a free blood and urine analysis, a test that costs hundreds of dollars and with no obligation to buy. With hundreds of life insurance companies competing for your business, you could pay substantially less. So if you have a life insurance policy and you want a second opinion, just go to www.rightonthemoneyshow.com and click on the life insurance for a second opinion.
Well, welcome everyone back to our first on the series called the Top 5 Retirement Topics Ignored by the Mainstream Media. I'm telling you, they're not talking about the things we've been talking about. What we're talking about in this segment, elder care in retirement, and I'm doing it, of course, with economist, talk show host, best-selling author, investment advisor, and master of science in financial services, Dan Casey. Dan, I salute your academic prowess again. But more than that, you're a comprehensive planner, and I like under our code, everything's correlated. We say I'm doing tax-free here, but then it gets me over to the Social Security side, right?
Right, yeah.
So everything's correlated. Everything integrates with each other. Elder care, how big? I just read Fidelity's, like 7-8 months ago, Fidelity's new number. We're spending, they say, $220 grand during retirement for elder care costs and medical care. Are you kidding me? Is it that high? Think about that. And that does not include the boomers' new longevity outlook.
Right.
That's just today's seniors, right?
Right.
And I noticed that a similar report said 70% of all seniors are today presently using some form of assisted home living. So we know it's out there.
Yeah.
I'm thinking Jean Clement in France lived 122 years, 164 days. Old Susanna just died
I did hear
at
that.
116, right? Willard Scott used to say happy birthday to a handful of Americans. Well, it's not a handful anymore of turning 100. 72,000 centurions in the United States.
Fastest growing, demographic. Yeah, it's amazing, isn't it?
And Dr. Dubray, this gerontologist, the famous out of Europe, famous gerontologist, he says the person who's going to first live to 150 is already born and on the earth.
Well, yeah, I did hear that.
I mean,
thought that's pretty cool. Yeah,
I'm sorry. So whatever my long-term cost is, I think is going to be bigger simply on the basis of longevity.
Yeah, exactly. It's just a matter of time before that's going to be something that's everybody's just going to have. Long-term care insurance it's again, people pay for insurance their whole life and they very rarely get anything out of it. Homeowners, automobiles. So, you bring this up and they just they don't even want to discuss it. But the problem is who needs long-term care insurance? Usually. If you don't have a whole lot of assets, you can still move them around and structure it to qualify for Medicaid. It's not that hard, even with the 5-year look back. The very wealthy, they can usually self-insure. They've got enough assets to take care of it without, depleting their assets. It's, of course, the people right in the middle class. Too many assets to kind of shuffle around to qualify for Medicaid. But, a nursing home being $90,000, the last MetLife study that came out can completely ruin your
Retirement.
Thank you.
Let me just say, until you do what I'm telling you to do, about 10 years ago, one of our agent/registered reps took his whole entire seminar, put him on a bus. We met at the Hotel 8, put him on a bus, and we toured the state facility nursing home.
Oh, geez, I bet you that was powerful.
That tour probably closed 15 to 20 cases because people said, I do not want to live like that.
Yeah.
See, so there's the shock and awe. By the way, good that you're seeing it at 55, 60 rather than figuring this out at 75, 80.
Yeah, exactly.
Okay, so it's important.
Yeah, and everybody that comes into my office, like for instance, all right, so do you know what the odds are that your house burns down?
Well, not much.
3%, right? 3 out of 100. Not very, but everybody has homeowners insurance, right? How about the odds of you totaling your car?
Well, I'm talking about Steve Savant.
Yeah, not you. The normal average guy.
Yeah, the average guy. Probably still low.
18%.
18%.
Everybody has automobile insurance. Do you know the odds of most retirees that I see needing some sort of long-term care? 72 out of 100, 72%. And most that come in haven't even looked at a quote. So it's really important that at least you look at a quote. The insurance companies have very creative ways to get that now.
Well, let's talk about the first one because I actually have a full, I actually bought it when you could.
Nice.
So I have a full nursing home, everything, standalone for my wife and myself.
Nice.
Done.
Yep.
And I'm paying it every year, and I hate it. I'm just telling you. Yeah, I'm bleeding. You say, Steve, it costs much, yeah, but it's $430,000 to $450,000 depending upon the inflation. That's the benefit, and I'm throwing out about $5,500. So a year. So no, I don't like making the payment.
I know.
I don't.
I know.
And I don't like making my car payment, but I do it.
Right, exactly.
So,
you need to get around, and you need to protect your assets with it.
But there's people here who can't qualify for that because they got health issues.
Yeah. Yeah, so and some people don't even want to do it because they're afraid to get turned down. So they won't even fill out the application. So there's ways, there's ways around everything, right? So like for your case, when you have a standalone policy with premiums, sometimes what I'll do is I'll find out what that premium is, and then we'll set aside some assets in a dividend-paying portfolio and have it kick off enough to pay that premium so you actually don't have to. It just sweeps out of that account. So that's sometimes how I eliminate that pain.
Oh, that's sweet. But I'll take that.
But and then other ways are, they've come up with these hybrids now between life insurance and annuities, where like one of them is, if you set aside, say you have part of your retirement portfolio in a conservative portfolio, 3%, 4%. Some companies say, well, just put some of that money, say it's $100,000, into this hybrid account, and they'll triple it or quadruple it into long-term care benefits for you immediately from when you put it in. And it's still earning your 3-4%. So it's still a conservative portion, but yet you're taking a small portion of your portfolio and protecting the whole thing with this from decimation of a long-term care event, an unplanned long-term care
Okay, so
event.
just to make sure I understood you, so I could have an annuity that allows a long-term care rider with it, addendum to the contract, and that the moment I buy it, it has its normal value, cash value or account value, but it also has this future value specifically for elder care that is 3, 4, 5 times the amount.
Exactly.
Okay, all right. So, and I just want to remind everybody, because it seems like I guess it's a decade ago, we had the Pension Protection Act come online, and they allow you to move some money out of that to a qualified annuity for long-term care, 1035, non-qualified, 1035 exchange, there could be some games to be played here because not many people have been using that law, which is now almost a decade old.
Yeah, and nobody knows about that one, the QLAC. And it allows you to, hold off in some of your IRA money, so it's doesn't have to be tapped until you reach a later age to, again, take longevity risk off the table.
Okay, let's say I'm looking at standalone. I may or may not be able to qualify. I'm looking at annuity, long-term care. I'm looking at now life insurance with a long-term care rider. Let's go punt back to our HECM segment, a couple segments back here for this show today. I have people, I was at a HECM, we were doing a seminar, we were talking about the HECM strategies, and the lady came up to me, a sweet gal, I'll just call her Dorothy for our sake, and she says, Steve, I have a home of my dreams. I don't have a mortgage. I have plenty of income and money coming in. What could HECM do for me? And I said, do you have long-term care? She goes, oh no, I couldn't qualify.
Yeah,
I said, have you looked at an annuity with a long-term care rider?
Yeah.
No, the math didn't work for me because I'm 70, whatever I am. So the math just didn't work.
Yep.
I tried the life insurance. That didn't work because I have to have a rate of return and I couldn't get it.
Okay.
So I said, okay. So I said, well, how about opening up a HECM equity line of credit as a backup? You may never use it. I don't know. You look pretty healthy to me today, but I don't know what tomorrow will bring.
Right.
I want you to open that line of credit if you need it for any long-term care or elder care, or you need to configure your home for geriatric living,
right.
or
Yeah.
you need to have your grandkids go and get Visiting Angels certified, live in your house, and pay them
Right.
out of that account, your equity line, which you never have to pay the annual interest or any of that. You never have to pay any of that back, just to have it as a backstop for long-term or elder care.
Yeah, there's lots of creative ways to get it done. The annuity, you don't even have to do any kind of exam. It's just an added benefit with no fees. A lot of times what happens is, you put your money in, it seasons for maybe 10 years, and then you can turn on income if you want, but if you need long-term care, that income doubles for a certain amount of time. No fees, so that's just an added benefit.
Shockingly, some insurance carriers now are giving lifestyle credits back into the contract. So what are they saying? Baby boomer retirees, I want you to start eating right. Can you do it? I want you to start doing good behavioral issues. Can you drop your smoke or whatever? Can you start exercising? They're actually giving you credits. And every time you go to your doctor and everything has a good bill of health, they look at your body mass weight, they look at your blood pressure, they look at all this stuff. They're actually crediting contracts back now for good living. So one of the greatest defenses against long-term care costs is keeping yourself in shape.
Yeah, absolutely.
And I think that's actually, Dan,
advice.
your generation, I think, is going to be more up to speed than we were.
Yeah,
because we came in on the late game of this whole thing of exercise, diet, and so forth. But I think your generation and the millennials in back of you, I think you guys are going to have a major opportunity. You're all going to live 100 years. You have a major opportunity, and you can prep for it now. So what am I saying on long-term care? The best part is prevention. Get in shape and get ready for retirement. Remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information from this segment. In our fifth segment, we're going to talk about retirement income dangers with Dan Casey, and there's plenty of them. We'll be right back after the break.
Shakespeare once said, "This above all, to thine own self be true." Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. It's difficult to make good decisions in life without knowing who you really are. And nowhere in life is this more important than making sound financial decisions. Creating a financial profile addresses your psychological disposition towards money, and that's a critical component in the decision-making process on saving, investing, and using insurance to protect your risk. Establishing your own risk tolerance is the first step in building a financial profile so you can measure your suitability for a financial product or strategy. There may be many risk tolerance tests available that can help you construct your own financial profile. One test that I use is a good place to start, and I'll email it to you free and without obligation. The test will take you about 10 minutes, and you'll be able to do it in the comfort and the privacy of your own home. So just go to www.rightonthemoneyshow.com and click on the free risk tolerance test. Once you calculate the results, you'll have an understanding about your attitude towards money.
Well, welcome back, everyone, to our first in a series on the top 5 retirement topics ignored by the mainstream media. In this segment, we're talking about retirement income dangers with economist, best-selling author, registered investment advisor, and Masters of Science and Financial Services, Dan Casey. Dan, there are dangers out there, and we're going to talk about them. But before we do, I want to talk about an omission. Most people say you have to have earned income for an IRA. So, we talked about the even a child, he has his lawn, and they can put him into a Roth IRA, but he has to have what?
Earned income.
Earned income.
Right.
But you say not for a non-working spouse doesn't necessarily have to have income to get an actual deductible IRA.
Yeah, exactly. And it goes back to the, IRS doesn't care who writes the check. So say in the scenario, husband and wife doesn't work. Husband makes at least $13,000 in that year. He can put a contribution in for his IRA, $6,500 max, and into hers, and she's not working at all. So in a spousal, that can happen. So the only limitation is your age. You can't be 70 and a half and older and receive a contribution, obviously, because that's when required and minimum distributions start. But the key thing is the recipient. So if the husband is 72 and he still has some earned income, he can put a contribution into her IRA if she's younger than 70 and a half. So it doesn't matter how old he is.
So no W-2 income, no 1099. I've been a non-working. Listen, well, I don't want to say non-working because if you've been a mother of four, you've been working.
Right, exactly.
But you haven't been earning. Okay, so I'm just saying that is a huge thing. How many times do you see people not even looking at that?
Oh no, I would. It's the vast majority.
Okay.
At Roth, the only limitations they have is just you base your income. It doesn't matter what age. You can always put money into a Roth if you're under the.
Well, I just want to get the double whammy of what you're just saying here, though. I have a spousal IRA that I did not have corresponding revenue for.
Exactly.
I'm getting a deduction on money I didn't earn. I just want to make sure we all got that.
Right.
Yeah, that should be huge, and that should be a given. Let's switch to the danger zone. Oh my gosh, we're in the danger zone. All right, I think everybody's finally over. I've been writing about this for 4 years, that the 4% withdrawal rate is pretty much done, cooked. I think Morningstar's below 3 now.
Okay.
I think Motley Fool's below 3. So everybody's saying that, which tells me, and I don't know if this is bad for us as advisors, it tells me that we cannot generate. This is what it tells me. I can't generate 4% clean from my stock dividend and my bond interest anymore. I just can't get it done.
That 4% is stuck in people's mind, and it's come from, I'm sure you've heard of Monte Carlo simulation.
Oh, yeah.
Do you know where that came from? The government came up with all these algorithms to figure out how nuclear waves disperse when nuclear bombs go off. So somehow we took it over in the finance world, and we came up with, if you take out 4% from a stock market portfolio over a year, you'll be fine, mostly. I think it's 92%. You'll be okay. You can outlive your money.
Wait. I'm so way back. You said they took the algorithms from a nuclear blast.
And you wonder why our clients get confused.
No, I figured this is totally appropriate for the bad withdrawal rate and sequence of returns.
There you go. That's perfect.
Oh my God. Perfect. Okay, go ahead. I didn't mean to interrupt you. I'm sorry, but I was just so stunned that you're saying
No,
this.
you just completely stepped all over my joke. My joke was
sorry.
my joke was, I flew here to see you, right?
Right.
If I walked up to the pilot and I said, what's my chance of making there alive? And he said, it's about 92% chance you will make it there alive. I would want to not take that flight. So same thing in retirement. You want as much guarantees as possible. Guarantee your income, let the rest grow if you want. But so it's that dirty little secret of sequence of returns that registered representatives, brokers usually don't like to talk about.
Okay, well, let's just map it out.
Okay.
During accumulation,
yes,
everything we're talking about is pretty much true. You've seen the Ibbotson charts going up and up and up. We've been accumulating for 30 years. Markets go up or down. We feel nothing because we're taking nothing out.
Right, and that's the key thing.
We're letting it ride.
If you look at it like a mountain, distribution side, put your flag in when you retire. Accumulation side, put your flag in, you retire. Distribution side, that's the side of the mountain that I specialize on. So, just like when you climb a mountain, most accidents, 2/3 of accidents happen on the way down. So the downside is just as important. Accumulation side, you can put money in, and if you're not taking it out, I don't care if you get bad returns in the beginning, great returns at the end, or vice versa. And I go through this in a seminar. I show, it just doesn't matter. But when you're on the distribution side and you're taking money out and you hit some bad years in the beginning, like maybe we are now, because we're at all-time highs again, it can decimate a portfolio if you're withdrawing money and the market's going down. So it's called sequence of returns, and stockbrokers don't like talking about it because they want your money in the market.
Well, I just want to tell everybody, this is a danger. I face this in reality. I have people that are my seniors, 10, 15 years older than me. We met in a luncheon, all women, everybody I think in that room was probably 70, whatever they were.
Yeah.
And it's an investment club. There were 3 women there that the one that I remember went from 850,000 portfolio down to 137 in 5 years.
Geez.
I said to her, when was the last time you met with your advisor? She said 5 years ago. So she's been taking out money that he said and then dipping into it on other things.
The market
not
go
watching
down.
and just never seeing the market having its problems in 215.
Yeah.
So she says, what do I do? And it's one of the most painful things as a planner. I cannot help this woman at her age.
There's no more money going in.
There's no more money. I told her, I said, you're just going to have to look at the equity position of your home, see if you can get reverse mortgage for a little bit of tax-free income, because you're out every place else. Now, should that advisor have been on the phone with her? I think he should have, and but she should have also made a little bit of proactive as well.
Right.
So we're looking at real life people, and but think about this: we're talking about normal mortality. What happens if this lady actually decides to live to 95?
Right.
It just exacerbates everything.
Yeah. We can show it in my office. We kind of show that we take all the knowns that we have, a couple of the unknowns, a couple of hypotheticals, and try to extrapolate that out to find out if you're taking this much money and the market does dive, like what would happen. So we kind of go through all that, which is usually why we end up guaranteeing their income and then growing the rest. If you've got ups and downs, that's fine if you're not taking money out.
Right.
If that's what you want to pass to your heirs or whatever, but at least guarantee the income if you can.
I think it's a risk management issue too, because I'm going to have domestic spending in retirement. I have my bills to pay. I'm going to never get away from that. Maybe I take vacations every year. Maybe I want to go see the grandkids.
Yeah.
Maybe I'm on a mission church with my, with my church.
Right.
I have costs that I know are fixed.
Yes.
Fixed costs. I can't keep matching up fixed costs with variable returns from the market. So I need to start matching up guaranteed income because I have guaranteed expenses.
Yeah, exactly.
Why is that so hard to figure out?
Because a lot of times the guaranteed income comes from insurance companies. And again, people say, annuities got bad names because usually, bad advisors sell bad annuities. But insurance companies have it figured out. There's a reason why every city you go to, they have the biggest buildings. They know what they're doing. And again, I try to use them to the benefit of my clients. There's a reason why they can offer incredible benefits and guarantee stuff because they're on both sides of the equation. They sell life insurance and annuities. And, in life insurance, they benefit if you don't die when they think you're going to because you're making payments and they don't have to pay out a death premium. Annuities, same thing with an immediate annuity. They benefit if you, you die sooner than they think because, they get the lump sum payment and they don't have to pay out for the rest of your life. So they've got it figured out. They're on both sides of the equation and they can really use this to the advantage and offer incredible products for retirees that do guarantee income for the rest of their life. Yeah, and their spouse's life if they want.
Well, this is going back to our couple segments earlier. If you were Jean Clement, who lived 122 years, 164 days, and you had a guaranteed lifetime annuity, that would have paid out all the way to her 122nd. I'm just staggered by these numbers.
And people assume you mean that when my balance runs out, then it stops. No, your balance could run out 10 years ago, and they'll continue to pay under law for the rest of your life, regardless of how long you live.
By the way, a little caveat to this. That's why it's so important. Remember, annuities have nothing to do with FDIC. Don't ever listen to anybody that says so. But it is dependent on the ratings of the carrier and their balance sheet. And people all the time say, Steve, is this company good? I watch all 6 rating services. I carry the financial profile summary sheet for all carriers. I'm a sick man. I carry them all. And when I make a decision on an annuity, it's going to be, do I have a quality balance sheet and a good rating services? It matters. It matters?
Yes, and as you know, they're under extreme strict guidelines of what they can do with their money, more so than banks. So, they have triple guarantees, and so they're a really great alternative for retirees for that guaranteed income portion of their needs.
No, I've noticed there's a couple of people always say, is it this one or that one? I notice we have single premium immediate annuity. We have deferred income annuity. You could even have an indexed annuity that has an income rider.
Sure.
And I never know. It's so funny. I never know which one's going to win. So actually, if you would have told me rates would change this fast and mortality credits in these contracts would change for the client, I would say, oh, no. Once a month, look at it. I look every week. I'm on Canex.com looking at these numbers.
I'm so sorry for your wife.
Oh, I'm a sick man. Yeah.
So, and all I do for my clients is whatever that gap is that we need to guarantee. You take Social Security, pensions, whatever that gap is of money they need. I just tell the staff, go out and find what's the lowest amount of money, the cheapest fees that we can guarantee that gap. Maybe it is an immediate annuity, maybe it's a deferred, maybe it's an index, whatever. So we look at all options.
Well, that's all the time we have for our show this week. I want to thank Dan Casey for being my very special guest. But before I go, remember what the good Reverend John Wesley once said: make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you right here next week on Right on the Money.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.